Good afternoon, everyone. Welcome back to the Finding Genius video series. We're joined with Stephen Sikes, the COO of Public. Stephen, thanks so much for joining us.
Yeah, I'm happy to be here. Thanks for having me.
Yeah, we're joining you in your basement, so I appreciate this look into
So
the
yeah,
work.
I think we've all had to have our makeshift offices. So I've tried to do the
Yeah,
best I can, but this was not intended. So
yeah. I'm keeping my camera high so you can't see everything on the floor.
exactly.
But Public is the investing social network. It's been just ripping during the pandemic and before that. And they take an interesting investing for social networks. It takes a community-based approach to the stock market. The platform is focused on long-term ownership rather than short-term speculation. And I think where I'd like to start, just to really get into the meat of the topic and then go more into your background, so we'll jump around a little bit, is it's been an interesting couple of months in the public markets, especially with the Reddit fueled rallies and kind of some of the investments. So could you maybe walk us through internally what was going on at the executive team or on the management level of at Public during the events around GameStop and Wall Street Bets a few months ago?
Yeah, sure. It was certainly a fun time. So I think for your listeners and viewers' benefits, I was actually sort of relatively new to Public and still am. I only joined from SoFi sort of in late October, early November. And so I'd been spending my nice, sort of 90 days getting up to speed, starting to improve, get some stuff in place from an operational perspective and, start to really figure out how things work and how things get done. And, things were going really, really well. The business had been growing really nicely through sort of the end of 2021 and had a great January, really record setting month. We were all super, super jazzed about how things were going. It was just like a steady drumbeat of growth, which is like what you want to see, right? Like, and then I think it was January 28th. It was a Thursday. I remember vividly, like waking up, and as a good COO does, I checked my dashboards on my phone before I even rolled out of bed because we're all addicted to the dashboards. That's why we work in consumer businesses, and there were big numbers there. And I was like, well, this is interesting. Around the same time, obviously, I discovered like Robinhood had sent out an email saying, hey, we're going to be shutting down a few stocks. And the backlash had started to build even as early as I think this was like between 6 and 7 a.m. And so I sent out a quick Slack and was like, guys, it's going to be a day. And, headed into the office. At that time, we were working out of a co-working space, just myself and Leif and Yannick, our two CEOs. And headed in, got in relatively early, and just watched the drumbeat of new customers coming in, and it was cool. We were having conversations internally about, hey, what does that day mean, right? We've been evaluating the markets and watching sort of what's going on with, GameStop and so on. And I think as Robinhood had framed it in that email that morning, if I remember correctly, it was pretty much framed in terms of like a risk management decision for their clients, right? I don't think their initial communication framed it as the capital issue that I think we noticed it turned out to be. But we were sort of having continual internal conversations about how to manage securities availability. What do we let people invest in? What don't we? How do we work our way through that? And we'd landed for at least during my tenure around the idea of helping educate people and provide information rather than trying to take paternalistic control. And so all we knew at that point was, well, it seemed like in response to these market events, one of our major competitors was
There's some rally going on right now in the background. They're calling you, trying to get hold of you.
Exactly. That was Yannick who got the old decline on my Apple Watch. So you're gonna have to wait a few. So we've got so we're going through these conversations, and again, a competitor took a different way, and we're always we're always evaluating our own approaches as a relatively young business and growing the way that we are. We always try and make sure we're being really intentional and thoughtful about what we're doing. And so here we are. Things are growing really quickly that morning based on this decision making we'd made previously. We're seeing an influx of sort of new clients of different different types and so on, and that goes on. And then at around 11 a.m. I got a phone call from our clearing firm saying, and of course I knew what this call was, right? At that point, like, I've been around the industry long enough to know, okay, there was something weird going on with the competitor, shut down some stocks. Like, okay, now, like, number two, number three guy at the clearing firm calls you and you're like, oh, I know what's about to come, right? Again, similar quick conversation, not exactly a friendly one. And, was pretty clear that they were running into the same issues that Robinhood was, and they were in the process of unwinding them, but they needed to turn off a few of those stocks at the time in order to sort of manage their balance sheet and their business. And so we ended up having to take those down. Go ahead.
Sorry, and for people who aren't familiar with it, what were the exact issues that the clearinghouses were going through, and how come public had a little bit of a major advantage to Robinhood in those few hours when new accounts were coming in, and trade was becoming so important where people, even just in a matter of minutes, wanted to get in and out.
Yeah, so without going too far down the rabbit hole, all clearing firms have to post a deposit to the NSCC, which is the National Securities Clearing Corporation, which is one of the entities, semi-governmental entities, that manages who owns what stocks and how to move stocks from one account and one customer to another. And all of that happens through the central clearinghouse. And every firm that's a member of that clearinghouse has to post capital to it to basically back up their customers' trades in case something were to go wrong with either the firm or the customer. They've got to be able to clear those trades, because again, trades don't clear automatically, and immediately they clear 2 days later, and so you've got that time to move that capital. Those capital requirements are tied to a risk model that NSCC maintains that's based on volatility in the market and what they're seeing in the trading data from the clearing firms itself. And so it can be highly variable in times of great volatility, especially along single names like GameStop. And so what happened was the NSCC came in and said, hey, we need more money. The amount of money they needed was more than, and again, I think Vlad from Robinhood has been pretty transparent in talking about this, now after the fact, but they needed more money than sort of Robinhood had ever raised cumulatively in its life. And they came in, I think they went to Apex with a very similar sort of message. And I do think there were differences in capitalization relative to customer size and the size of the trading volume between Robinhood and Apex. I think it turns out Apex was better capitalized for the situation, and so Robinhood had to go quickly raise capital and meaningfully change what they let their customers trade over the course of more than a week from that point, right before they fully turned everything back on. I think Apex was able to deal with it in a couple of hours.
Okay, so when they approached you at 12 p.m. or so, within a few hours, public was back, and there was no.
Yeah, I want to say it was like 11:30 to maybe 2:30. It was something. It was just a few hours where.
Could you have ever expected anything like this? I mean, beyond just the social side of it. I mean, because public is built on the element of social. So, but the other sides of it, about these clearing issues and where Robinhood would just pull securities altogether. Was there anything in the tea leaves, since you had worked at SoFi and McKinsey before this and been in fintech for a while, that you might have predicted some of this?
I don't know. Again, I think these sorts of many standard deviations outside of the norm events are tough to predict. But I think as you wrap your head around the confluence of events that allowed for it, right? Sort of internet scale collaboration on the stock market, on the U.S. securities market for the first time, had a real impact as it never been seen before. I don't think that surprises me, like after the fact, right? I don't think I was, I think if you'd asked any market observer, myself included, a year ago, hey, how much impact do you really think Robinhood investors have on the market? I think the sort of common narrative among the FinTwitterati and the sort of the punditry was that it was muted, right? And it was always overblown, and it was just a nice press story. But I think retail investors writ large, I think, demonstrated that wasn't true. Again, we don't have perfect information even still around who was trading GameStop and what institutional versus retail flows looked like and so on. But it's hard to deny that there was some impact there. Even if it were amplified by institutions from sort of a retail groundswell, which was more or less a first of its kind, and it's not crazy to think about in the past. Now, the second thing I will say is our job as managers and custodians and stewards of our customers' assets is to plan for stuff like this, right?
Right.
And so I think, it's incumbent upon us all to step back and say, hey, are we well enough capitalized? Do we have the right infrastructure to be able to meet the needs of our customers through any, literally not like cutting off the tail of 8 standard deviation or whatever, cutting off some crazy things, but no, like we
Yeah.
need to be robust enough to deal with any situation because we're dealing with people's money, and there's nothing more important than maintaining the trust of your clientele when you're dealing with their money. And so I think as we think about business operators and like managing our capital position going forward, I think it's really important to make sure that like we don't risk those sorts of things, because obviously it's going to be, have a pretty big negative impact at relatively, and it would have been relatively low cost to avoid for that team beforehand. So
Right.
yeah, that's what it comes back to.
And you've mentioned trust, and in the days that followed those events, the payment for order flow was a big piece or term that kept being thrown around. So could you talk a bit about that? And Public made a decision shortly after all this, or was it before, to remove that altogether? But could you help explain what that is? Because I think some of last testimony and everything else we heard, it didn't really fully get at it. So it would be helpful to understand it.
Yeah, so payment for order flow comes from just the simple question of, if Stephen wants to buy 1 share of Tesla on Public or Robinhood, who's selling me that 1 share and at what price? And the way the market has evolved is that the vast majority of those trades, the other side of those trades ends up being what's called an internalizer or a wholesaler, or most generously a market maker. And because there's a difference in the price that stack is being offered for and being bid for. So what the difference between what somebody will buy it or sell it for, there's always a difference between those two in the market. There's some value at stake between those two, right? And if you assume that the market is sort of evenly hitting both sides, right, there's a spread to be gained there. And so there are market makers like Virtu and Citadel who are on the other side of that trade, trying to sort of smooth out the difference in time and trying to just capture that spread between trades. And that became a pretty lucrative business. And secondarily, that became a business that helped spawn a bunch of other trading businesses within Citadel and Virtu, right? So they're both, they like to wear the hat as market maker, but they're broadly proprietary traders, and they're, some more than others in the space, they're trading for the purposes of filling orders with Stephen sometimes, but then a lot of their trading is just in general trying to find edge in the market and try and find places to make money through arbitrage trades and other sorts of liquidity provision, and then also just taking bets. The idea that the market makers don't take directional bets is a little bit funny. So, sorry, stepping
Right.
back.
But in one of those areas could be, we don't need to name names, but someone like the parties that you just mentioned front running some of the trades that Stephen places before you can get in, so the price ends up increasing over time with them.
Yeah, so front running is a very, very specific like let's do capital F, capital R, right?
Okay.
Front run, like that is a very, very specific, regulatorily prohibited business activity, which basically, simplifying here pretty dramatically, but that means Stephen sends in his order for 100 shares of Tesla. Before the person I sent it to fills it, they go out and do a bunch of other stuff, which then results in me getting a higher price. That's front running, like capital F, capital R. That's not like, there's no one, I think, that's looked at this that believes that any of the firms or anyone participating in this business is doing that, right? That is, one, it's like incredibly illegal.
Yeah.
2, it's incredibly obvious and very easy to verify, and it would just be a poor business risk. Like the money at stake isn't worth it from retail trades. Like again, nobody believes that capital F, capital R front running is going on.
Okay.
What I will say in contrast, and this is the hardest thing to know, because it's. So let's go back to what I was explaining about the quote unquote internalizers, wholesalers, is that there are 2 components of their businesses. There's a component of the business which is trading with Stephen and providing liquidity to me when I want to buy my 1 share of Tesla. Then there are a bunch of other trading desks, algorithms, other traders trying to make money in the market through a bunch of other strategies. Um, the honest answer is the market making business of trading with Steven helps those other strategies. And it's not always clear how or why or who's getting the better end of those deals. And those other strategies, all that other stuff is not well regulated. Again, it's honestly, when Steven trades with anyone, right, in that scenario, public, the wholesaler, everyone involved in the trade is regulatorily required to try and get that customer the best execution they can, and it's measured rigorously and monitored on an ongoing basis by sort of many regulatory entities. That's a highly regulated trade. And again, similar to the front running, like everyone does a pretty good job of delivering good execution. And what good execution or best execution means is probably, it's more of a challenge than I think people would like, because again, execution's a very complex target. But let's just assume for now that specific trade is pretty well executed by all people, and there's a lot of scrutiny that goes into it.
Interesting.
At the same time, that all those other trading activities are not at all regulated or monitored. So if they're not trading directly and they're not filling an order directly from a retail investor, mostly from a retail or investor or some other directed counterparty, they're not really measured in the same way. And so anytime they're trading for their own proprietary trades, right, they could be trading in the market or on exchange or wherever with their own strategies that may or may not be informed by the retail trends that they've been seeing or otherwise. And again, it's not that anybody's doing anything wrong. These are businesses, and again, they have an asset, which is the order flow, and then they're trying to make trading profits off that asset in many different ways. And again, I'm not asserting anybody's doing anything wrong again, but you don't know, right? A lot of this information is being piped through a bunch of different teams and algorithms that it's impossible to look through and say, hey, is there a conflict here?
Right.
Okay, so now let's take the payment. Sorry, we'll go back to what payment for order flow is. These wholesalers, internalizers, market makers are providing a rebate back to the brokerage firm for sending Steven's order directly to them. And that directed order creates a very direct interest between the brokerage and the wholesaler that does two things. One, it incentivizes the brokerage financially to have their customers trade more. That's a problem, right?
Right.
I think the academia and the better understanding of retail behaviors and all of the studies that have been done would say that the more people trade, the worse outcomes they have. So one, there's a conflict of interest there if I'm monetizing directly their trading behavior and doing so without the customer really knowing about it. Again, it's pseudo-disclosed in most cases. But then the second is it makes me a party to all of that other stuff. And so when our members and customers come and ask, hey, what are the conflicts of interest here? What's going on with PFOF? Are you getting paid? Who else is getting again, not my like customer information, but they're getting some information in the form of that order. No customer information or PII is being shared, obviously. It's just the order, but there is information being sent there. And so who's being privileged with that information, and ultimately what is the brokerage's economics? And as we evaluated, so we've gone full circle from what is PFOF back to public, as we looked at that market structure and we said, hey, public stands for trying to help people be better long-term investors. And so one, aligning our business model in any way with trading more often, right? And in a way that's non-transparent, like that was problematic. And the second is, we just try to be really transparent with our customers, again, to build trust, our members and try to build trust like I described earlier. And when they ask about who's executing the orders, who's getting a good deal there, what are their interests there? Are they? I know this industry really well. I've spent a lot of time, and I do spend a lot of time talking with these wholesalers and internalizers, and I really do try to understand it. But the honest answer is they don't know. The people I'm talking to don't know how the retail information is being used and whether that's to my benefit as a retail investor, to our brokerage's benefit or not. And it's because, again, they're relatively unconstrained in all those trading activities. And so they perform a valuable function in the market, but not in a way that we want to be sort of directly tied to public as a business.
Right. And that's really interesting. So as the COO of Public, when you're looking at payment for order flow, and then you're seeing the subsequent testimonies in Congress and the entire debate, are you predicting or expecting any major regulation to come out as a result of all of this, or things to change, or do you think PFOF, to use the right term, does that just stay in kind of in the business and public just stays away from that?
I don't know. I like, and our goal was to, one, build a business model that we think is aligned with our customers' best interest. I think we're getting closer and closer to there and continuing to push the boundaries of making that possible. And we'll continue to try and find this other way. The second is we always want to be transparent about our business practices. And so we've been, completely open about what we're doing and the puts and takes of the model we're doing and how we're approaching it. And again, make sure our customers or our members are fully aware and informed of that. I think we'll see what action takes place, but I think the third point is making sure there's choice in the market.
Right.
Again, I think, well disclosed choice and making sure that consumers more broadly are well informed of what's going on and that there are different models of companies that they can work with. Some that, again, there could be arguments that payment for order flow is a rational trade for some people, and they're willing to deal with the conflicts of interest in exchange for, again, I don't actually believe it exists, but in exchange for some potential, maybe they end up cutting in the customer in some of these rebates, right? And so on. Like, maybe that ends up being a model that exists. And I think choice in the market is a good thing. I won't speculate as to what the regulatory or legislative angles could be, but to say, I think we're seeing interest and so, it could change, but I think, again, I tend to expect things to be to stick more with the status quo. And again, we're preparing our business for whatever comes, but at a minimum, we're going to give customers choice.
And then, so just to completely go in a different angle, then, when you're talking about, you just mentioned about how frequent trading, the longer term hold investors end up outperforming. You talked about being aligned with customers, financial literacy. Can you talk about, and I know you joined in 2018, but that entire decision to make this community-based aspect of investing something that will help improve financial literacy, and what the crux of that hypothesis was, because that's the biggest differentiator between you all and, I mean, beyond the smaller logistics things, but why is that such an interesting thing that helps improve financial literacy?
Yeah, it's a great question. One I don't think we talk about. We talk about it a lot, but I don't know that it's getting quite as much attention as it should. I think people like to talk about, when they talk about social media and investing and that sort of thing, they like to talk about the Reddit GameStop organization and market manipulation and all that. But the reality is, and I can't take any credit for the original idea, but it tracks perfectly with what I've seen in my career. And what that is, with a really fine point on it, is that when you're dealing with relatively inexperienced investors, people who are new to the markets, as we all were at some point in our lives, the best way for them to learn is, one, from people from other people, right? And the second is by doing. And so I think we've tried to build the best platform we can to help people, one, learn from a broader community of like-minded investors who are, creating content that'll help them be better investors. And the second is create a platform for that investment that will allow them to learn in a relatively safe environment as they sort of improve their skills and learn more about the markets and so on. So it's the combination of those two things at previous jobs and previous experiences led me to a world where if you throw up like a learn box on some page and you expect people to click on that to read blog posts or articles about investing, like, you're going to be really disappointed with one, how many people actually click on those two things, and two, how much how well your members, your customers understanding grows.
Right.
But if you create the context for them to learn within a community and to learn by doing, I think we'll be really pleased with how it grows.
Another thing that public talks about quite often, this is probably in line with the building financial literacy and being a smarter investor, but public has decided not to, at the moment at least, offer margin trading or options trading. I'm not that aware that it's changed, but what was the decision behind that? Is that
I
something that
think
customers are clamoring for? Are they using other platforms then? How do you manage that between what your
I think
customers?
it goes back to I think it goes back to one of our key points of differentiation is that uh, we are defining our platform as being for people who want to be good long-term investors.
Right.
And the honest answer is that in building a long-term, fundamentally sound investment portfolio, whether that be, again, something that's like ETF based and modern portfolio theory based, or somebody that wants to actively manage a well-diversified portfolio of single stock bets, in both of those scenarios, or sorry, in neither of those scenarios do options or margin help.
Right.
They
Right.
really don't. They really don't. And so in the vast, vast majority of retail investors' long-term portfolios, those two don't play a part.
Yeah.
And I
Interesting.
think as we think about building the initial platform that helps people get started investing and become great investors over time, those aren't there. There
Yeah.
are uses of both that can fit within somebody's long-term portfolio. Now, that's not how they're being used in most retail implementations, but um, they can exist, but they're not high up on our priority list in order to, again, as we think about fulfilling sort of the original mission.
And then as you continue to productize against that original mission, what else is next, or even within the purview of where you're sitting, where public continues to grow over the next 5, 10 years? I know you just closed a massive fundraising round. So where is that money going? To the extent that you can share that, or numbers, or anything you're willing to share that's
Yeah,
makes
I think the roadmap's a little, the roadmap's a little harder to speak to. I mean, I think we have talked about some of sort of the core investment features that we hope to launch over the next few months. That I think are things that we think are sort of table stakes for that sort of long term, even the long term investors and people are really clamoring for. So I think we've published some stuff there and said some
yeah.
stuff around around those features. The longer term I think is probably something we'll hold closer to the vest.
Okay.
I think when you ask about broader priorities, I'll say the number one priority for our business is still to grow the number of investors that we're serving, right? The
Right.
number of people that ultimately come to public and want to use public to learn the markets, start investing, or even just grow to be a better investor. And we're continuing to build products and features that we think will help public fit those needs. And paired with that, continue to build a scalable org that can meet a scalable organ system that can
Yeah.
meet those challenges as we see the sharp growth that we've seen over the last few months. And so we're getting closer and closer there, but we still have to be a lot bigger to really realize the full potential of this. So growth is still our number one priority.
Right. We have a few more minutes left. A few more questions, but the to switch gears from public for a second. But the last question I think will be helpful for aspiring entrepreneurs, fintech enthusiasts, COOs, product managers. What is on your dashboard that you saw that morning? Like, what are some of the metrics and things, the graphs that you're looking at beyond just subscriber growth? Anybody managing a fintech startup or a consumer company, what should they be looking at?
Yeah, my dashboards, I tend to use the most proximate view, so the front end data, the quickest response I can get on sort of all key steps in the funnel. And so look at those sort of day over day, week over week, month over month, and see, hey, the very top of the funnel for us we call signups. So that's the very first thing I look at is, hey, what's our sign up volume? How's that growing? Ultimately, how's that converting down funnel into approved accounts and ultimately investors? And so keeping an eye on how those are trending. Other good operational metrics are sort of, again, each of the steps in those funnels. There are a couple that are more sensitive than others, and again, more sensitive to sort of our efforts and what we're responsible for doing versus some stuff that's sort of automated or always on. We keep an eye on sort of trading volumes to look at what's trending there, both in terms of aggregate volumes and sort of individual names that are trending. What else is the top of my metrics? And then I like every morning to sort of check let's say the back end source of truth data on dollar flows. So what are the total deposits? What were the total withdrawals? What was the total trading volume? Those sorts of sort of flows data that really only comes in once a day in fully baked form.
Interesting. And just, I guess, as the last question, more focused on you and more broad and holistic. You left the U.S. Army, you went to McKinsey, then you've worked at SoFi, now public. What drove you towards fintech? How have you seen the space evolve over time? What are some of the areas where you still see opportunity in the future, or just general advice to other fintech founders you might have?
Yeah, so it my career path is it's been entirely driven by the people I've been surrounded by. I think I made my decision to join the Army, and that one's a little bit separate. But as I left the Army, I knew I was, one, solving for my own developmental curve, but two, I wanted to be surrounded by uh, just the best people I could find and to learn from. And so that led me to McKinsey. Ultimately, that was a great experience. And the work I ended up doing at McKinsey was mostly because I made the same decision, which was among the people I got to work with earlier or had met in passing to try and, work with those that most inspired me and I thought I could learn the most from. And that led me to, sort of the growth in financial services world within McKinsey, which naturally in sort of 2013, 14, 15, 16 led to the fintech world, which was not even really called the fintech world
Right.
then, but it was working on sort of digital strategies for big incumbents in the financial services world, which then led me naturally to an opportunity at SoFi. And at each of those steps, I was solving for the best people and the best opportunity to learn from great people. SoFi was an incredible place to work for many years, surrounded by some of the best operators you could imagine, in a time when it was a business that was intentionally growing from sort of two verticals to like nine, and to be surrounded by people that had that energy of trying to really build into those adjacencies was fantastic. Ultimately, I think that was the exciting part for me, and I saw the opportunity to join public, which was I mean, again, it goes back to people, but the best, literally the best in class product engineering, marketing, growth teams that I could sort of underwrite from the outside in. And those are the scarce resources in the work that we do, especially in the consumer fintech. And admittedly, like, those aren't the things that I do every day. So it's great to try and surround myself with people that are really fantastic at stuff that I don't know as well and can learn. So that gives me opportunities to learn from their expertise. And so I was able to find an opportunity to help out in the stuff that I'm good at here, and it's been a fun ride so far.
That's great, Steve. Thank you so much for this. This is super interesting, and I think people are really going to enjoy and learn a lot from this. So thank you.
Of course.